Welcome and welcome to Finweek Money Matters. This is the show that helps you manage your finances. I am Dumisho Greater. Coming up on the show today, we take a look at a new life insurance company that is Different Life, the prospects for IT group Datatec, and we have a panel of experts in studio with us that will be telling us all about tax-free savings and how to invest your money. But before we get into that, please do send us any comments or feedback to moneymatters@abn360.com. But first, let's get into this week's cover story. Consumers are spoiled for choice when it comes to tax-free savings accounts, with financial services players launching a number of new products since the start of the month. This complies with the Treasury's rules. Finweek took an in-depth look at the prospects on offer to make it easier for you to make sure that you can pick. In studio with us, we have this week's Finweek editor, that is Jana Marais. Jana, thank you so much. I'm getting all tongue-tied. Maybe I'm just really excited about this topic. Tax-free Treasury products. How does this work? Whilst you're doing this in-depth analysis, what did you come across?
Yes, I think we've seen quite a range of products that's been launched already since the start of the month. So it really ranges from products where you can basically do something that's similar to a cash deposit, to other products that perhaps is a bit more complicated, where you can invest in shares or bonds or listed property or whatever the case may be. So there really is a range covering for a wide range of consumers. I think we've covered about 12 or 15 in our story. So there should be something in there for everyone.
What's been the take-up so far? Yes, it's been in since the beginning of this month, but have we seen any significant uptake?
I think it's a bit early to say exactly how popular it's been, but the feedback we've been getting is that there's huge interest, and companies have been getting a lot of queries from consumers who are considering investing in these products. But perhaps I think one of the challenges will be whether people actually save more if they just swap savings from an existing savings product into the tax-free savings products. So I think the aim of Treasury is to really increase the overall savings rate and not to have just a switch. But time will tell. We'll definitely keep an eye on that.
Who exactly is being targeted here?
Look, I think Treasury has said as well that they're really looking at low and middle income consumers to try and get them to save more. I think the good thing about these products are that it's quite transparent. It's pretty simple to understand. The fees are fixed and very easy to understand. You know, I think sometimes it gets very confusing. 1% of this or 0.5% of that. So it's really quite simple and easy. You know exactly what you're investing in. You know, if you're a high-end earner who, you know, like somebody like Sizwe Nkosana, who just cashed out 60 million rands worth of shares, I don't think the tax-free savings account is going to make a huge difference to your life. But, you know, everything up to 30,000 rand a year that you save will be tax-free, and that includes dividends or capital gains or interest. So certainly, I think everyone should be putting some money into those accounts at least.
And I'm sure you're going to be seeing a lot of financial services providers coming to the fore with all of these products, but we'll be delving into that in just a little bit. That was Jana Marais, of course. She's the editor from Finweek. Let's now move on and take a look at the punt of the week. When the Y2K bubble burst in the year 2000, Datatec was one of South Africa's most high-profile victims. After a lengthy consolidation of more than a decade, it is regaining sturdy upside and looks set to get back to its all-time high of 146 Rand a share. Joining us now from our Cape Town studios to discuss the outlook for Datatec is Finweek contributor, that's Moxima Gama. Moxima, you're very optimistic. You think that Datatec can get back to its former glory, to sit back at what, 146 Rand a share? Looking at where Datatec currently is, we're sitting at around 62. Is this not a little ambitious?
Not at all. The call was based on more of a sentimental, based on sentiment rather than fundamentals. Although the fundamentals are still looking pretty good, they're not probably producing results that are quite successful consecutively, but their strategy is quite, it's got longevity. I'm also tongue-tied now, to at least that 146 level. So what has happened is it's the type of pattern that's formed in technical analysis known as a bottoming-up pattern, and breaking out of that consolidation phase, as you could see in the chart there, which was around that 45 Rand level. You could then see upside above 62. You really want to go aggressive, because now it's the ascending phase of the pattern that could see it go to 160, rather 146. It obviously won't do it you know, in tomorrow or within a couple of months. This is a gradual call with occasional pullbacks now and then, corrections, which should pose as a buying opportunity. The fundamentals are still looking good, which I'm not really deterring from, because we are in a technology age where it is increasing, especially in Africa, and with Datatec at least cementing themselves with the US, we could see a lot of upside coming up here.
So that would be the investment case, and especially it does have that Rand hedge aspect to it, Moxima.
Right. So what it's done is it's also kind of, because it's also listed overseas, you're an investor who is kind of investing in an overseas product, but not really. So you have the benefits of two benefits of investing in South Africa, but effectively also investing in the US internationally because of how it's structured, which is a bonus, because a weaker Rand then also appreciates their earnings, and we are in a bear trend in our Rand, so we should at least get good earnings and upside. So this is both fundamental but more sentimental based approach of completing that bottoming up pattern and headed to its all-time high.
Moxima, if you look at the US technology companies, their valuations are looking rather high. Would you say that we are poised for another tech bubble?
Look, I think we've learned from the first, and a lot of wounds were, I mean, a decade consolidation means they were licking their wounds, and they've had time to heal from all of that. I don't necessarily think it would get to a bubble, because we've done it before, we've reached it, and I think there's a lot of lessons that we learned from that. So that being said, we should just at least enjoy the appreciations of a share that was brutally dropped to at least its all-time high and even beyond. So I'm strong about this and quite confident about this call.
Oh, thank you so much for that. That was the Finweek contributor, Moxima Gama. Up next, we unpack this week's trend of the week. We are talking about life insurance, and we're looking at a different take. Brothers Philip and Ethel Tomlinson's belief that business and philanthropy can coexist has led to the establishment of a new life insurance firm called Different Life. In studio with me to discuss how they're using technology to shake up the market and do some good in the process is Philip Tomlinson, a CEO of Different Life. Philip, thanks so much. The insurance industry, it's very saturated. You want to shake things up. How do you think you're going to be able to break into this market?
It is, in some respects, a saturated market. We see two big opportunities for Different Life. The first one is in technology, and we have a very technology-strong offering, and we believe we're getting a jump on existing players because of their legacy systems, which constrain what they can offer to customers. The second reason, and that's what really makes Different Life different, and that's philanthropy. We're bringing philanthropy into business in a very fundamental way, and we think that gives us a way, particularly to communicate with Different Life customers through new media, through social media. We can engage with them on a level that existing insurance companies can't.
I want to read something that, reading an article that was written about Different Life, and when I was reading it, I was not sure where the difference comes in. So I'm just going to read an extract here. You're looking at cost efficiencies for technology. You're offering a digital experience whereby the consumer can engage by a financial services provider online. And the second part is you also have a call center with consultants who provide information about the product but not advice. This sounds very much like what is already out in the market.
The core of it is similar. We are still selling life insurance, but our structure as a business is much more a technology startup and not a traditional life insurance company. That means that our web interface to customers is consistently enhanced, it's consistently improving. We can take customer feedback and we can make that into rapid changes so that our market is getting exactly what they're looking for. If you take a view of a traditional life insurance company, they may change their technology on perhaps a quarterly or 6-monthly basis, maybe even less than that, whereas a technology company will make those changes daily, at least weekly. So it will be a far more dynamic environment. And that means that the whole experience of the customer coming to buy life insurance will be changed and will be enhanced. It will be much more in line to what you would expect from an internet company and electronic sales, not traditional, stodgy, paperwork-intensive life insurance. So we think Different Life does have a real differentiator there.
We'll touch on the philanthropy aspect in just a moment, but you're still a financial services provider. And with that, with the new regulations that have been coming into the insurance sector, POPI treating customers fairly, how are you dealing with that, especially seeing that you are looking at a technological type of way in order to get into the market?
Well, there is a significant change in the regulatory space in life insurance, and it is making it perhaps more complicated to operate in. We start with a blank page, so we can build our information security around the POPI regulations. We can build our customer engagement around treating customers fairly considerations. When we look at the retail distribution review, we know exactly where the market's going. We can build processes and engagement with customers around that. So we see ourselves as being able to start with sight of all of these regulations as a big advantage for us.
Philip, the philanthropy aspect, whenever you think about philanthropy, you think about moral compass, ethics, you think ethics and profits and business. How are you marrying the two? How is this working?
Well, there's a question that could be asked of saying, can you put business and philanthropy together? The approach that we're taking is to say, how can our society continue to grow and improve if you can't take the power of business and blend it with the heart of philanthropy? So philanthropy for Different Life is not an add-on. It's not something we do as well. It's the absolute core of what we're about. Profit maximization is what typically drives a business. We're focused on impact maximization. And we've embedded philanthropy into the products, into the sales process, into the brand, into the commercial models. Everything we do is about engaging with Different Life customers and making sure that we can maximize impact in South Africa.
Where do you donate the money to? I mean, what are some of your projects that you're working on?
We have, as a technology company, we've got a second platform. The first one is differentlife.co.za. That's the customer interface for life insurance. The second platform is different.org. It is a crowdfunding philanthropy platform, and Different Life customers, as well as anyone else, can go to that site and select from a range of curated projects where we partner with existing NGOs, and funds can be donated to those projects. Now, a few things different about our philanthropy platform over some of the existing ones. Firstly, 100% of what goes to what is donated goes directly to the project. So that means that Different Life picks up all the costs, credit card fees. There's no administration charge. There's absolutely nothing. 100% of donation goes to where it's needed. The second differentiator is because we are able to, we want to engage with Different Life customers, we want to tell the world about our business through philanthropy, we will be marketing those projects, and we will be also closing the loop and giving feedback to donors to say this is how your money was spent. That's something that's been missing from philanthropy too many times. And then maybe the biggest differentiator of that platform and the way it ties into Different Life, if you buy a Different Life policy, your first premium every year will go into your different.org account to be allocated to a charity, to a project. And then if you refer someone and invite them to join Different Life and they sign up, we'll send another month's premium into your different.org account. So that supercharges it, and that thoroughly embeds philanthropy into the heart of our life insurance business.
Oh, Philip, thank you so much for making the time to join us. Different Life, bringing something different there to insurance. That was Philip Tomlinson. He's the CEO of Different Life. Stay tuned, because when we come back, we do have a panel of experts, and we're going to be talking about those tax savings incentives that the Treasury has put into place. Stay tuned for that conversation. Welcome back. You're still watching Finweek Money Matters. Remember, this is the show that helps you manage your finances. Well, tax-free savings accounts, they can be great vehicles for long-term savings, but how do you pick one from all the available options? In studio with us to explain this and what you need to consider before you open a tax-free savings account is Nerina Visser. She's a director at etfSA. Anthony Katakuzinos. Let me get this right. Katakuzinos, there we go. Retail Chief Operating Officer at Stanlib and Finweek journalist Lameez Omarjee. Thank you so much for making the time to join us. Anthony, I apologize, I'm going to get this right.
Pleasure.
Nerina, let me start with you. Just remind us, these tax-free savings that have come in was the beginning of this month. Just remind us what they are and what's available out there.
All right, so Section 12T of the Income Tax Act is the new legislation that was tabled, and under this legislation it allows individuals, South African individuals, to save up to 30,000 Rand per year into a savings or investment account that is suitably or demarcated as a tax-free product.
So, I'm just going to stop you there. Yes. We're just going to fix something on you so we can make sure everybody can hear you. But I'm going to move on to Anthony, who's going to pick up from where you left off in terms of what's available out there and where this exactly stems from.
Yeah, so I think it's an exciting new initiative from Treasury to encourage savings. So a lot of providers have come out with products, and I think which is fantastic because I think it offers choice to people. But I think the investor needs to be comfortable with a couple of things. He needs to be comfortable with the institution he's going to deal with, and if they have a relationship with one, well, stick to it if it has. Also see what they're investing for. So if it's a long-term investment, which I think this is aimed at, trying to encourage long-term savings, then I think you need to pick the appropriate assets under that. So for long-term investing of 5 to 10 years, why have deposits? Rather be looking at long-term growth assets, things like equity funds, balance funds and things like that for the long-term growth is my personal view, and it's the view of our organisation. So I think those are the type of criteria that you need to look at in terms of choosing where and what to invest in.
Lameez, you wrote the story, so I'm sure you must have a couple of questions for our experts.
Yeah, one of the things that the financial advisors I spoke to were concerned about was that people wouldn't understand how the contributions really work because they can have multiple accounts at multiple service providers and they could incur a penalty of 40%. So what is your take on that in bringing the right information across to all these people inquiring about it?
I think we fixed you now, Nerina, so let's have a look.
I think it is an incredibly important point, and the onus is on the investor or on the individual to make sure that they don't exceed their annual limit. The product or solution provider can't check that because there's no ways that I know if you come to me and open an account and you also